All right, if you're a renter, I bet you've typed this exact phrase into Google at some point. Cheapest renter's insurance. We've all done it, right? It seems like a smart goal, but in this explainer, we're going to pull back the curtain and show you why that super low price tag, it might just be the most expensive mistake you can make. So that's the big question, isn't it? Is the cheapest insurance really a good deal when it comes to protecting everything you own? I mean, saving a few bucks a month feels awesome. Who wouldn't want that? But the real question, the one we need to ask, is what are you actually giving up for that bargain price? And here's the tough truth. More often than not, that rock bottom price is a total financial trap. Yeah, it looks like a fantastic deal on the surface, but it's hiding some serious risks. And the worst part? You usually only find out about them when it's way too late, like right after a disaster, when you're trying to file a claim. All right, so let's dive into the lure of cheap. Because that low monthly premium, it's incredibly tempting. But it's so important to understand the trade-offs that are happening behind the scenes to make that low price even possible. Okay, so it really just boils down to a super simple trade-off. Think about it. For an insurance company to offer you a crazy low monthly premium, they have to reduce their own risk. And how do they do that? Well, by limiting how much they might have to pay you when something goes wrong. And they do this with two main tools: sky-high deductibles and really low coverage limits. So what does that actually look like in the real world? Let's say, just imagine, your apartment gets burglarized, and they take about $8,000 worth of your stuff. Ugh, total nightmare. But with that cheap policy, you might have a deductible of $2,500. That means you have to come up with that $2,500 out of your own pocket before the insurance company pays a single cent. And that right there, that brings us to the very real, very high cost of cheap. You see, all those savings you were so happy about, they can be completely wiped out and then some the second you actually need to use your policy. Let's break down exactly how that happens. Okay, pay attention, because this might be the single most important thing to understand in any insurance policy. It's the difference between actual cash value, or ACV, and replacement cost, or RCV. Now, most cheap policies, they're based on ACV. So if your 5-year-old TV gets stolen, they pay you what a 5-year-old TV is worth today, which isn't much, maybe $100. But what you really want is replacement cost. That gives you enough cash to walk into a store and buy a brand new, similar TV. The difference in what you get back is honestly enormous. This table really lays it all out, doesn't it? Let's just walk through these trade-offs. With an actual cash value policy, yeah, your monthly premium is lower. But when your $1,000 laptop gets stolen, you might only get a check for $300. That high deductible, say $2,500, it saves you a ton on the premium. But if you have a $3,000 loss, you only get $500 back from insurance. And don't even get me started on low liability limits. If a friend gets seriously hurt in your apartment, a $50,000 limit could be gone in a flash, leaving you on the hook for the rest. And here's one people forget: no scheduled property. You save a little by not adding special coverage, but that means your $5,000 engagement ring, it might only be covered for the standard limit, like $1,500. That's a huge loss. Okay, so I know this might sound a little doom and gloom, but it's not. This isn't about giving up and paying a fortune. It's about shifting our thinking from finding the cheapest plan to finding the best value. So let's talk about the smart way to save. There are absolutely ways to lower your costs without gutting your coverage. All right, the number one, hands down, most effective way to save money, it's bundling. Seriously, if you have car insurance, combining it with your renter's policy is a total no-brainer. Insurance companies love this, and they'll reward you with big discounts, often somewhere between 15 and 25%. I mean, look at the chart. The savings are legit. And the best part, you're not cutting a single bit of coverage to get that discount. But it doesn't stop at bundling. You've got to be proactive and ask your agent about every single discount you might qualify for. You have a smoke alarm? A deadbolt on your door? Ask for a discount. You're willing to pay for the whole year up front or set up autopay? Guess what? There's a discount for that. If you haven't filed a claim in a while, or you're part of a certain professional group, you could be saving even more money. Okay, now for the flip side. Let's talk about what to watch out for. You know that old saying, if it seems too good to be true, it probably is? Well, it's especially true with insurance. There are some huge red flags that can help you spot a policy that's, well, more of a risk than a relief. You really have to trust your gut during the sales process. If an agent seems cagey or they're trying to discourage you from reading the fine print, that's a problem. If they can't give you a straight answer about what's not covered, or they're hitting you with high-pressure stuff like, this deal is only good for today, run. And probably the biggest red flag of all, if you get one quote that is 50% cheaper than everyone else for the same coverage, you have to ask yourself, what am I not seeing? Because look, here's the bottom line. A cheap policy is completely and utterly worthless if the company behind it can't actually pay your claim when you need them to. And this part right here is non-negotiable. I'm serious. Before you sign on the dotted line with any company, you have to check their financial strength rating. You can find this from agencies like AM Best, and it basically tells you if the company has its act together financially. You're looking for a rating of A, which means excellent, or higher. Anything less is just not worth the risk. All right, let's pull all of this together into a simple, straightforward action plan. Think of this as your roadmap for finding the absolute best value, not just the lowest price. Okay, step 1. Figure out what you actually need. Go through your apartment and get a rough idea of what all your stuff is worth. Then, pick a deductible that you could actually afford to pay tomorrow, no sweat. Step 2, get multiple quotes, at least 3 to 5. And this is key. Make sure you're asking for the exact same coverage limits from each one so you're doing a real apples-to-apples comparison. And finally, step 3, finalize with confidence. Before you buy, review that final policy, double-check that the company has that A financial rating we talked about, and then you can purchase, knowing you made a smart choice. You know, there's a quote from our source material that just hits the nail on the head. The biggest mistake is buying a price tag instead of a safety net. It's all about that mental shift, right? Moving your focus away from just that small monthly number to what you're actually getting for your money. So I'll leave you with this one last thought. When you have a minute, go find your own renter's insurance policy. Look it over and ask yourself, honestly, did you buy a price tag or did you buy a safety net? Because in the end, knowing the difference is everything.